Today's housing market presents some encouraging developments for potential home buyers as mortgage rates continue their downward trend. This week, the average 30-year fixed mortgage rate has fallen to 6.94%, and the 15-year fixed rate has decreased to 6.24%. These reductions mark the third consecutive week of declining rates, offering a much-needed respite for buyers who have faced higher rates in recent months. Freddie Mac chief economist Sam Khater noted that spring home buyers received an unexpected windfall this week as mortgage rates fell below the 7% threshold for the first time in over a month. This decline in rates, coupled with an increase in the total inventory of both new and existing homes, is a positive development for the housing market. Although data on previously owned home sales showed a decline, the greater supply of homes and the recent downward trend in rates provide a more favorable environment for buyers. With mortgage rates ticking down and more homes available on the market, prospective buyers have more options than they have had in recent months. This confluence of factors suggests that it might be an ideal time to start house hunting before the spring home buying season concludes. The decreased rates mean lower monthly payments and potentially significant savings over the life of a loan. For instance, a $400,000 30-year mortgage at a 6.94% rate results in a monthly payment of about $2,645, with total interest paid over the loan term amounting to $552,240. Conversely, a $400,000 15-year mortgage at a 6.24% rate would require higher monthly payments of about $3,428, but significantly reduce the total interest paid to $216,952. For those trying to understand the financial implications better, the free Yahoo Finance Mortgage Calculator can be a useful tool to play around with different rates, term lengths, and loan amounts. This calculator provides a clearer picture of what monthly payments and overall costs would look like under various scenarios. When choosing between a 30-year and a 15-year mortgage, it's essential to understand the differences. Generally, 15-year mortgage rates are lower than 30-year rates. However, the shorter term will result in higher monthly payments but lower total interest paid over the life of the loan. Fixed-rate mortgages lock in your rate from the start, ensuring consistent monthly payments throughout the loan term. This stability is beneficial for long-term financial planning. On the other hand, adjustable-rate mortgages, ARMs, start with a fixed rate for a set period, typically lower than fixed-rate mortgages. After this initial period, the rate adjusts periodically based on market conditions. For instance, with a 7/1 ARM, the rate is locked for the first 7 years and then adjusts annually. The risk with ARMs is that after the initial fixed period, your rate could increase significantly, leading to higher monthly payments. However, ARMs can be attractive if you plan to sell or refinance before the adjustable period begins. Evaluating your long-term plans and financial stability is crucial when choosing between these mortgage types. Many potential buyers are also curious about when mortgage rates might drop significantly. Unfortunately, substantial decreases are unlikely in 2024. According to Fannie Mae's May housing forecast, 30-year fixed rates are expected to end 2024 at 7% and then decrease slightly to 6.6% in 2025. The Mortgage Bankers Association predicts a drop to 6.5% by the end of this year and further down to 5.9% by the end of 2025. The trajectory of future mortgage rates will largely depend on the Federal Reserve's decisions on the federal funds rate throughout the year. While the federal funds rate doesn't directly affect mortgage rates, it influences overall economic conditions. Typically, when the Fed rate drops, mortgage rates tend to follow. The next Federal Reserve meeting in mid-June will be crucial in determining the near-term direction of mortgage rates. In summary, the current market conditions, with declining mortgage rates and an increase in home inventory, create a favorable environment for potential home buyers. If you're considering buying a home, now might be an excellent time to take advantage of these conditions before the spring home buying season ends. Lower rates and a greater selection of homes provide an opportune moment to make a move in the housing market. Whether you're a first-time buyer or looking to refinance, understanding the current mortgage landscape and planning accordingly can lead to significant financial benefits. Stay tuned for further updates and insights as the housing market continues to evolve.